A new conflict between the United States and Iran has put fresh pressure on world markets. This tension is not just affecting oil and stocks, it is also hitting currencies in ways many people did not expect. But one of the biggest surprises is happening with the Japanese yen. The yen is one of the world's three major safe haven currencies, along with the US dollar and the Swiss franc. Normally, when war or conflict breaks out, safe haven currencies tend to hold steady or even rise as investors look for safety. But this time, something different is happening. The yen is falling, and it has now dropped to levels not seen in decades against the US dollar. Why does this matter so much? For years, many investors and companies have borrowed money in Japanese yen because interest rates in Japan were extremely low. They use that borrowed money to buy other assets, especially US technology stocks. This strategy is known as the yen carry trade. As long as the yen stayed weak and stable, this trade worked well. But now, as the yen crashes further, cracks are starting to show in that system. A well-known technical chart analyst named Kevin Wadsworth, who runs a service called North Star Bad Charts, has been closely watching the situation. He believes the weakness in the yen, combined with pressure building in tech stocks, is creating a dangerous setup. On the price charts, the Nasdaq 100 index, which is heavy with technology companies, appears to be forming a pattern some analysts call a diamond top. Historically, this kind of pattern can come before a sharp and sudden drop in price. If that drop happens, it would not just affect stock traders. According to Wadsworth, it could be the trigger for a much bigger shift in the financial world, a shift where money moves out of stocks and into precious metals like gold and silver. This is not a new idea. Wadsworth points out that history has seen this kind of movement before. Nearly 100 years ago, in the late 1920s and into the 1930s, there was a similar rotation. Investors pulled money out of the stock market and moved it into commodities, including precious metals. A similar pattern also appeared in the 1970s, a decade known for high inflation and rising interest rates. To study these patterns clearly, Wadsworth looks at a specific comparison. The price of gold, or sometimes silver, measured against the S&P 500 stock index. He calls this comparison the Rosetta Stone of investing, because it helps translate confusing market behavior into something that can actually be understood and measured over time. Right now, this comparison chart is showing something important. Stock market indices, when priced in gold, have actually been trending downward for years. In fact, Wadsworth notes that major indices like the Nasdaq, the S&P 500, and the Dow Jones all reached their peak value versus gold about 26 years ago, back in the year 2000, during the dot-com boom. In US dollar terms, these indices have gone on to hit new all-time highs. But measured against gold, they never recovered to those earlier levels. What has not happened yet, according to Wadsworth, is what he calls the capital rotation event. This is the moment when a wide range of assets, including major stock indices, break down sharply when measured against gold. He believes the early signs of this rotation have been building quietly for years, but the dramatic tipping point is still ahead. Gold and silver have already gone through a heavy price correction recently. Silver has fallen about 50% from its highs, and gold has dropped more than 30%. Because of this, Wadsworth suggests that much of the damage in precious metals may already be behind us, even if a stock market shock is still coming. To understand where gold and silver might be heading, it helps to look at how markets have behaved during similar periods in the past. This is exactly what Kevin Wadsworth focuses on when he studies price charts going back many decades. He explains that these kinds of rotations, where money moves out of stocks and into precious metals, are not random events. They tend to follow patterns that can be studied and measured using long-term charts. By pulling up historical data on trading platforms, analysts can look back over 100 years and find clear examples of this happening before. One of the clearest examples took place in the 1970s. During that decade, the price of gold was allowed to float freely for the first time in the United States, after being fixed for many years before that. Because gold had been pegged to a set price earlier on, comparing it directly to stock markets before the 1970s can be tricky. To work around this, analysts like Wadsworth often use silver instead. Since silver's relationship with gold has stayed fairly consistent since the early 1970s, this allows them to look further back in time and still get a reliable picture. When silver is compared to the S&P 500 going back to the 1960s and 1970s, the chart shows patterns that look very similar to what is happening in markets today. This comparison is not about claiming that money moves directly and instantly from one asset into another. Instead, it shows the relative strength between stocks and precious metals over time, revealing the natural back and forth cycle between periods when investors favor stocks and periods when they favor hard assets like gold and silver. Wadsworth describes this stock versus metals comparison as one of the most important tools an investor can use. He believes understanding it can help someone stay correctly positioned for the next decade, since these cycles tend to unfold slowly, often over 10, 15, or even 20 years. Right now, when looking at gold compared to the S&P 500, There is a visible trend where the stock market has been losing ground against gold over the past several years. However, Wadsworth is careful to point out that this slow shift is different from what he calls the actual capital rotation event, a sharper and more decisive break where a wide range of assets fall clearly and quickly when measured against gold. According to current chart readings, that sharper event has not fully arrived yet. Wadsworth suggests that if signs of real trouble begin appearing in the stock market, perhaps within the current quarter or by the final quarter of the year, it could set the stage for that rotation to accelerate. There's an important detail worth noting here. Normally, when a stock market shock happens, gold and silver can sometimes get pulled down along with everything else, especially if metals prices were already stretched high beforehand. But Wadsworth points out that the opposite situation exists today. Gold and silver have already gone through a significant price correction. Because of this, he believes any further stock market weakness is less likely to drag precious metals down significantly. Instead, gold and silver may only dip modestly further before finding a bottom, then recover and outperform stocks fairly quickly afterward. He also highlights specific price levels that matter for silver right now. On shorter time frames, a level around $64 is seen as an important resistance point. If silver can push through that level and hold above it, Wadsworth suggests it would be an early technical signal that the recovery phase is beginning. On longer time frames, levels in the mid-50s have already acted as a support zone for several weeks. These technical levels are not just theory. Wadsworth explains that both human traders and automated trading systems recognize these price zones, which is part of why they tend to hold up as real turning points on the chart, rather than random numbers. If the pattern Kevin Wadsworth describes plays out, the effects would reach far beyond a small group of traders watching charts. A genuine rotation out of stocks and into precious metals would touch everyday savers, retirees, and long-term investors across the country. One of the biggest debates in the investing world right now involves a familiar narrative: the idea that the U.S. government could one day revalue its gold reserves to help deal with the national debt. Wadsworth acknowledges that this idea makes a certain kind of logical sense in paper. It could, in theory, ease some financial pressure, but he is careful to separate this from confirmed fact. There is no way to know for certain whether such a move will ever happen or when. He treats it as an unknown, not something to plan around with confidence. Instead, he prefers to focus on what price charts are already showing, regardless of whether that kind of dramatic policy change ever takes place. The more immediate and measurable concern, according to Wadsworth, is the relationship between the stock market and hard assets like gold and silver. He believes the technical evidence already points toward gold trending higher over the coming years, independent of any single political or economic narrative. This matters because it removes some of the guesswork. Instead of relying on rumors or predictions about government decisions, investors can look at long-term price behavior and draw conclusions from patterns that have repeated across different decades. For everyday people, the practical question becomes what this means for their own money. Wadsworth draws a clear line between three types of market participants: traders, investors, and long-term stackers, meaning people who steadily buy gold or silver over time without worrying about short-term price swings. Each group needs a different mindset. Traders, he explains, operate on shorter time frames. They use strict rules, setting a price where they will exit if a trade goes against them, and a target price where they will take profits if it goes their way. This approach allows a trader to lose money on several trades in a row and still come out ahead overall, as long as their winning trades are large enough to offset the losses. It is a numbers-driven approach built around discipline rather than emotion. Investors, on the other hand, typically hold positions for years, focusing on the broader direction of the trend rather than short-term price movements. Wadsworth notes that identifying whether stocks or gold are the stronger long-term trend can help investors decide where to place their money for the years ahead, rather than reacting to daily headlines. Then there are the long-term stackers, people who buy small amounts of gold or silver regularly, often as part of a retirement strategy, regardless of short-term price changes. For this group, Wadsworth suggests that short-term corrections matter far less than the overall long-term direction of the market. This distinction carries real weight for the broader public. Many people are not full-time traders and do not want to track price charts every day. Understanding which category they fall into, trader, investor, or stacker, can help them avoid unnecessary stress during periods of market volatility, like the one unfolding right now with the yen and tech stocks. There is also a wider economic angle to consider. Wadsworth points to long-term trends in U.S. government debt levels compared to the overall size of the economy, along with underinvestment in mining and resource production over the years. These factors, he suggests, could contribute to tighter supply and stronger demand dynamics for precious metals in the years ahead, separate from any short-term news cycle. As this story continues to unfold, many viewers are likely asking themselves the same question: what should someone actually do with this information? While no one can predict the market with complete certainty, there are some key developments worth watching closely in the months ahead. According to Kevin Wadsworth, one of the most important levels to track is silver's resistance zone around $64. If silver manages to break above that level and hold there, it could be an early signal that the recovery phase many analysts are expecting is beginning to take shape. On the other hand, if silver slips below the mid-50s support zone, Wadsworth notes that a further move down into the low to mid-40s is possible before any real turnaround begins. Either way, he emphasizes that the bulk of the price correction may already be behind the market, even if some time is still needed before a clear upward trend resumes. Beyond individual price levels, viewers should also keep an eye on the broader signals discussed throughout this video. The ongoing weakness in the Japanese yen, ongoing developments in the Middle East, and how tech stocks respond to pressure from unwinding borrowed positions. Wadsworth believes that if cracks continue to appear in the stock market over the coming months, it could serve as the spark for the larger capital rotation he has been tracking for years. Longer term, some analysts, including Wadsworth, have discussed price targets as high as $15,000 for gold and around $300 for silver over the next 5 to 7 years. It is important to remember these are projections based on technical chart analysis and historical patterns, not guarantees. Markets can move in unexpected ways, and no forecast should be treated as certain. For viewers trying to make sense of all this, it may help to ask a few honest questions. Are you someone who trades short-term price swings, or are you more focused on long-term positioning? Do current global tensions and currency movements change how you think about protecting your savings? And how much of your perspective is shaped by recent headlines compared to longer historical patterns going back decades? These are not easy questions, and there's no single right answer for everyone. Different people have different goals, different timelines, and different comfort levels with risk. What matters most is understanding which category fits your own situation, whether that is trading, investing, or simply building a long-term position slowly over time. Looking ahead, the coming months could bring important developments. Movements in the yen, shifts in stock market indices like the Nasdaq, and how gold and silver behave around their key technical levels will all offer clues about whether this rotation is truly underway or still building. Viewers who want to stay informed should keep watching how these markets interact with one another, rather than focusing on any single headline in isolation. As always, it is worth remembering that no single analyst, chart, or prediction holds all the answers. Markets are shaped by countless factors, and staying informed means looking at multiple sources of information, staying patient, and avoiding decisions driven by fear or excitement in either direction. Currency Matrix will continue following this story closely, breaking down new developments as they happen, and helping viewers understand what the data is really showing, without hype and without unnecessary drama. Thank you for spending this time with us today. If this video helped bring some clarity to a complicated and uncertain moment in the markets, consider staying connected with Currency Matrix for future updates. Whether you're here as a trader, an investor, or someone simply trying to protect what you have built over the years, understanding these long-term patterns may prove valuable in the months and years ahead. This story is still being written, one chart, one headline, and one decision at a time.